Think about this for a second. Today, when you check the interest rate on your mortgage, swipe a credit card, or look at the green paper bills in your wallet, you are participating in a system you treat like a natural law. You treat the Federal Reserve's decisions on the cost of money like gravity, or the changing of the seasons. It is an unquestioned permanent pillar of modern life. But here is the thing. It hasn't always been there. For the first 137 years of its existence, the United States operated without a permanent central bank. There was no singular authority controlling the money supply, and no lender of last resort waiting behind the scene. And yet, during that exact same period, America transformed from a fragile collection of war-torn colonies drowning in debt into a global economic superpower. So the question isn't just academic, it's urgent. How did the American economy survive without the one institution we now consider absolutely essential to modern finance? The answer is far stranger, far messier, and far more revealing about the nature of power than most people realize. America didn't simply glide through those years on luck. It lurched from crisis to crisis, from stability to absolute chaos. The country experimented with central banks, killed them, watched the system collapse, and then tried again. Which raises the deeper question. When the Federal Reserve was finally created in 1913, was it actually built to protect the average citizen? Or was it the ultimate prize in a high-stakes war over financial control? To answer that, we need to go back to the very beginning, to a moment when the United States didn't even have a functioning currency. During the Revolutionary War, the Continental Congress had no power to tax and no gold reserves. Desperately trying to finance a war against the British Empire, it printed paper notes called Continentals. The execution was catastrophic. By 1780, the continental dollar collapsed to the point of being entirely worthless, leaving ordinary soldiers and farmers holding stacks of expensive paper. This experience left an incredibly deep scar on the American psyche, breeding a pathologically allergic reaction to paper money and centralized financial power. But when George Washington appointed Alexander Hamilton as the first Secretary of the Treasury in 1789, Hamilton inherited a broke and broken nation. His solution was audacious: consolidate the state's war debts into a single national debt and create a national bank to manage it. To Hamilton, a national bank was not just a ledger. It was a political machine designed to tie the personal fortunes of the country's wealthiest merchants to the survival of the federal government. It was a brilliant plan, but it was deeply threatening to a large number of Americans. Thomas Jefferson saw Hamilton's bank as a Trojan horse, warning that it would concentrate wealth and influence in the hands of a northern financial elite. Hamilton won the first round, and the first Bank of the United States opened in 1791. But politics is not governed by objective success. By 1811, with the Jeffersonians firmly in power, the bank's charter renewal failed, leaving the nation to face the War of 1812, with no centralized way to coordinate its finances. Within 5 years, the monetary chaos was so severe that Congress chartered the Second Bank of the United States in 1816. Under the disciplined leadership of Nicholas Biddle, the bank grew into one of the most powerful financial institutions on earth. Then came Andrew Jackson. Jackson carried a visceral hatred of banks, rooted in an early career experience where he was personally ruined by worthless paper notes. To Jackson, the second bank was a hydra of corruption, an unaccountable monster that enriched wealthy stockholders at the expense of ordinary workers. In 1832, Jackson vetoed the bank's charter renewal, framing the bank as a threat to individual liberty. He then ordered all federal deposits withdrawn and distributed to state-chartered pet banks. When the second bank expired in 1836, America entered the free banking era. For nearly 3 decades, virtually anyone who could raise a modest amount of capital could open a bank and print their own paper banknotes. The result was a nightmare of confusion. By the 1850s, thousands of different banknotes circulated across the country, each trading at a discount. Counterfeiting became an American pastime. 1/3 of all paper currency was fake. Merchants had to keep banknote directories on their counters just to conduct basic business. This decentralized Wild West brought immense freedom and rapid localized growth, but it left the American financial system with absolutely no shock absorber. The Civil War established a rigid national banking system, but the core vulnerability remained. There was no central authority to manage the money supply. This rigidity created a seasonal crisis. Every autumn, when farmers needed credit to move crops, interest rates spiked. Every spring, excess cash flowed back to New York, fueling Wall Street speculation. The system was locked in a loop of boom and bust, experiencing major panics in 1873, 1884, and 1893. The final crisis arrived in October of 1907, triggered by a spectacularly failed attempt to corner a copper stock. A run began on the Knickerbocker Trust Company. Within days, the panic threatened to swallow the entire financial sector, and there was no government institution with the cash to stop it. The survival of the United States economy fell to one man, 70-year-old private banker John Pierpont Morgan. Acting as a one-man central bank, Morgan turned his private library into a command center. In one of the most dramatic nights of American finance, Morgan literally locked the city's wealthiest trust company presidents inside his library, refusing to let them leave until they pledged $25 million of their own money to rescue the weakest banks. The last holdout signed at 4:45 in the morning. Morgan's intervention worked, but the episode exposed an almost unbelievable truth. The entire American financial system rested not on law, but on the willingness of a single private titan to open his checkbook. What happens when there is no J.P. Morgan? The panic galvanized Congress. In 1908, Senator Nelson Aldrich, a powerful Republican with deep family ties to Rockefeller, sponsored legislation to design a solution. Knowing the public was deeply suspicious of Wall Street, Aldrich orchestrated one of the most secretive meetings in American history. On the night of November 22, 1910, a group of the nation's most powerful bankers boarded a private railroad car in Hoboken, New Jersey. They used only first names, avoided being seen together, and carried shotguns as props. Their cover story was a duck hunting trip to Jekyll Island, Georgia. For 10 days, in absolute seclusion, they hammered out the details of what would become the Aldrich Plan. It called for a single national institution controlled by bankers that would hold reserves, issue currency, and act as a lender of last resort. It was, in everything but name, a central bank. When the plan was presented, populists rejected it on principle. The deadlock was broken by the election of 1912, which swept Woodrow Wilson into the White House. Wilson was committed to banking reform, but he knew the political architecture had to be different. The resulting Federal Reserve Act of 1913 was a classic American compromise. To appease the fear of centralized power, it created not a single central bank, but a decentralized system of 12 regional reserve banks to ensure public accountability. The governing board in Washington would be appointed by the president. On December 23, 1913, Woodrow Wilson signed the act into law. The 137-year experiment of running a dynamic economy without a central bank was over. The Federal Reserve was marketed as a neutral, scientific stabilizer to prevent bank runs and smooth out the business cycle. But the creation of this engine had a far more profound consequence. It fundamentally altered the relationship between the citizen and the state. By centralizing the control of credit, the Fed removed the natural boundaries that had historically kept the federal government lean. For over a century, the size of government was constrained by how much it could raise through tariffs and land sales. With the Federal Reserve capable of buying government debt and managing an elastic currency, those limits vanished. As the 20th century progressed, the risk of economic failure was quietly shifted. We saw this in 2008, when the housing market collapsed. The institutions designed to stabilize the system stepped in with trillions of dollars in bailouts. The cost of preserving the financial architecture was borne by the taxpayers. Today, the Federal Reserve is arguably the most powerful institution in the modern economy. Its brief statements on interest rates dictate whether ordinary people can buy a home, whether businesses can afford to hire, and whether the value of your savings will be preserved or eroded by inflation. The history of American banking is not a simple story of progress.